Hey everyone, I'm Emily and we're here at the Creighton Business School with Tim Bastian. He's a professor of economics here, and today we're going to get his take on the financial crisis and the recession. So it's been over a year since the start of this financial crisis. Can you just boil down what's been causing this?
Sure. When we look back at the root causes of the financial crisis, we can boil it down to just a couple of simple things that happened. And people will say, "Oh, Tim, that's much more complex than that." But let me get to just some key points. The first one is that so much of this came from as a reaction to policy initiatives that are in Washington. We wanted people to own homes. And that in itself is a great initiative. We want people to be owners of homes because they take better care of their houses. It's a way to build wealth. That's great. So what happened is we made it easier for people to buy homes. FHA loans, VA loans, Fannie Mae and Freddie Mac, those types of places where it was easy to get loans. And it was a well-intended policy. But in order to do that, we also had, the federal government had to get banks willing to create more loans. So they provided loan guarantees, but they also came to the point where in order to get some of the buyers of houses who did not have very good credit, they had to take those loans and do what's known as collateralizing them, or putting them together so that the risk could be spread out over many owners instead of just a few banks. So that was good too, and then we learned that that ended up having some dire consequences to it. But the real reason why we had so many problems is that in order to have those collateralized mortgage obligations out there to spread the risk, the people that were holding them also insisted upon having some type of insurance to go along with those. So in case they went bad, we're still insured. And the term that you may have heard in the news is credit default swaps. A credit default swap was simply a small little insurance policy that said if those collateralized mortgage obligations went bad, you'd get paid. But here's the critical mistake that was made. You could buy those credit default swaps, insurance on the mortgages, even if you didn't own the mortgages themselves. Which meant you could buy something and hope that maybe this thing went under even though you didn't own it. And what happened is the market grew for these. In fact, there was at one time something like $65 trillion worth of these things out there, derivatives they're called. And the mountain grew and grew and grew of these things. But what happened is that these small insurance policies were insuring something that had very, very little risk. You can think of it if you've ever seen a hole-in-one contest where you take a shot for $1, and if you get a hole-in-one, you win $1 million. Well, that's not exactly how those contests work. It's if you hit a hole-in-one on your shot, or maybe you have 3 shots for $1, you get to come back later on in the week and try for another hole-in-one. Well, if you're like me, if you golf like me, my chances of a hole-in-one are probably a 1 in a million. Well, that meant that you had to hit 2 shots at 1 in a million. Well, statistically speaking, that's like 1 in a trillion. The problem is that in the housing crisis, where everybody was betting on these credit default swaps to fail, right? Even because it made a lot of sense, very small amount and a huge payoff if it happened. Well, all of a sudden, somebody made 2 holes in 1. And now these banks who had been encouraged to have these and sell these credit default swaps, all of a sudden were now sitting and looking at this giant liability that they had to pay out. But it came back to some really bad policies.
So Tim, you use terms like betting, and you say you're allowed to buy insurance on an asset without actually owning it. That pretty much sounds like gambling, is it?
It sounds like we're going to go over to across the river to the casinos. Exactly right. And what happened is that when you're able to buy insurance on an asset that you don't own, it violates the very first principle of insurance, which means that you have to have what's known as an insurable interest in order to be able to buy insurance on that asset. If not, we could go out and buy life insurance on our favorite celebrity who leads a destructive lifestyle. You can't do that because you don't have an insurable interest in that person. But that's exactly what was created. And when that's created, you have a lot of people gambling. And when you think that the bet is a great bet, you can make a lot of it. Nobody's going to make 2 holes in 1 in the same week, right? But they did. So the economy has picked up a lot of pieces from the financial crisis, and there's been kind of a healing in the banks. So what's your outlook for the future? The banking system has been healing, and what we're seeing now with the Federal Reserve is now trying to take some of the extra money that they had in the system, and they're trying to bring it out. And that's a good thing. What the Federal Reserve is doing right now is they're making available to banks places to park their cash. And that's a good thing. They're trying to draw some of this money out of the system. But what we see now is the banks, even though they're returning to profitability, they're still not willing to lend a lot right now. The economy in itself, as far as growth is coming, we are seeing some slow growth. Unfortunately, it's not translating into a lot of new jobs at all. And the problem is we've got some other issues out there right now in Washington, where the healthcare bill and also the cap and trade legislation, that businesses don't know how they're going to materialize or what's going to happen. But businesses are not going to start hiring workers until they know what their future costs are going to be for those workers. So right now, businesses, even though they're making more money, making more profits, being much more productive, they're not in a hiring mode right now because they don't know what their future costs are going to be based on some of this legislation that's sitting out there.
All right, very good.
Thank you.
Yeah.